What's up, everyone? Chris Lopez here, and this is our second episode in Ask an Investor series. And this is an idea that my co-host Jenny Bayless had. So, Jenny, how are you?
I'm doing great. How about you, Chris?
Doing really good. And give us a quick rundown on what the Ask the Investor series is.
Yeah. So, the idea is to basically bring other investors in to the studio and just have a conversation, answer their questions real time, because we've found that a lot of people tend to have similar questions or, similar extended type questions that we can, hopefully answer a lot of people's questions that they might be having and pertaining to their real estate investments at a wider scale, but having a more intimate conversation with someone. So yeah, that's kind of the goal, and we're always looking to tailor it and tweak it. So if you have any comments, just definitely let us know.
Or want to be on the show or have a question.
Yeah.
So our guest today is Catie Lawrence. Catie, how are you?
I'm doing well. Thank you so much for having me.
Yeah,
this is a big moment for me.
Well, this is fun to have you on here. So I'm going to give a quick background. If I butcher anything, let me know. But you and your husband, you guys live in Arvada. He's a GC. You recently just left your W-2 job to pursue investing full-time, be an agent full-time. You and your husband partner up to do some flips. You've done some BRRRRs. You're just in the investing space. Mm-hmm. And you guys are building your portfolio. And also, you just taken a really exciting step to go out there and just change your career. So is that a good background?
That is a good background.
Good.
We have some rentals as well and one long-distance rental. But small portfolio, but yeah.
Yeah. And I know you've got lots of going on between just growing a portfolio, going to rentals, changing your career. So what's your first question?
So my first question is, again, we've been in the space for a few years. Denver is obviously a hot market. We've traditionally used our own capital and financing. That is just one of the main issues, or not issues, but main barriers to get into this space, especially in a hot market. So from a financing perspective, I really wanted to go down the route and talk to you about partnerships. What does that look like? This is a pretty wide question that I had. Partnerships. There's a lot of different areas that you can dive into. But structuring a partnership that makes sense to not only you and your team, but also the other person, providing value. What value are you getting from the other person? So just kind of diving into partnerships, what you have seen in the market and how people have positioned themselves.
So this will be a great rabbit's hole to talk about.
Yeah.
I know. Partnerships, that's a question.
Because no two are alike. But let me ask you one question. The main goal of the partnership is around financing. Is it to bring access to like capital and financing? Is that the main goal?
Correct. Yeah. So currently, again, we use a lot of our own capital. We have leverage through cash out refis and HELOCs and that sort. But typically, we are just doing one project at a time because most of our financing is wrapped into that one project. So if something comes up, if we see something that's really a great opportunity, hard money lending is really the only other way that we could do it, or potentially private money. But from a partnership perspective, I just wanted to explore what does that even look like. And
these are for primarily flips, BRRRRs, rentals, or
I would honestly be open to anything.
Okay.
From a tax perspective, lately we found that BRRRRing is really where our portfolio is taking us. But I think a good flip would be a great opportunity as well. Again, this is a very broad question. But I think just having an opportunity to jump on something quickly with a partner that's kind of already established would be the goal. Because again, right now we can't scale, and we don't necessarily want to scale huge. We want to do a couple a year, but right now we're again at that one project per. I mean, we're doing one project at a time because we don't have the capital to do more.
So before we get into partnerships, you mentioned why, because I always try to play devil's advocate with people. I enjoy that. Why not hard money? Why not use hard money as a partner and avoid having to involve another human being?
Sure. I think that is definitely an avenue that we want to explore as well. I have actually talked to some hard money lenders. It's just if we could establish ourselves with someone else that's doing this as well, I think that could be mutually beneficial. I think, again, this is a very hot market. It's Denver. We're in Arvada, so we've done flips all over. But I think just establishing that relationship with someone, I think, is appealing to me.
Let me peel back this some more, because you said be mutually beneficial.
Yeah.
So describe that to me, because this will eventually be the operating agreement.
Okay. So mutually beneficial. So from our perspective, which is what I can speak to, my husband's a contractor. We already have subs that are, tried and true. We've used them in multiple flips. I'm an agent. We have some experience. So making sure that what the other person is providing is not necessarily, leveling up to our level, but they're getting something out of it as well. So whether they're bringing money and we can create some sort of, percentage deal. I honestly don't even know what that looks like. I think providing somebody else an opportunity to get in this space by partnering with us could be good as well. I mean, this is a business about networking and relationship building and providing a good home for somebody in the community. So I think that is appealing to me.
Okay. And so your partner would get a return on their capital. That's the main thing, right?
Correct.
Okay.
Yeah. Or maybe they have a crew and this time we're just providing the capital and kind of resting on our laurels a little bit because we want to travel.
But that'd be a future partnership.
But that would be a future partnership.
So
I think to establish something initially that's mutually beneficial, whatever that means, because to your point, let's have a contract. We need to make sure that we're writing this down. It can't just be like, hey, you want to do this? Let's do it. So just the different ways to structure that.
Okay.
I'm very curious about, how it's worked for other people and just, yeah.
Okay. Where do you want? I wanted to ask those questions first, Jenny.
Yeah, no, I mean, I could probably go a million different directions, but I'll maybe just start with like the quick and easy ones first. I think what's kind of coming to mind is there's a short-term relationship and a long-term relationship. Long-term being BRRRR,
Yep.
short-term being flip. There's debt partners and equity partners. I've personally, the only person who I partner with is my husband from an equity standpoint.
Same.
Yeah. So it's like I have partnered with people from a debt standpoint on a short-term basis, if that makes sense. So in lieu of using hard money, I've partnered with a debt partner who ended up turning out to be family, which, you never know who's into it, right? So on the takeout financing, and then once we finished the renovation on that BRRRR, we turned it into long-term debt, and that person was removed. So, and that was great for both of us.
On that property, did you refinance and then pull money out and then pay them back?
Yes.
Okay.
Yep.
Can I back this on to make sure? Because you threw a lot out there.
Yeah.
So equity is ownership. So, the three of us are equal partners in, 1, 2, 3 Arvada. Debt is someone who's not on title, but is helping you with the
note
financing,
holder.
right?
Financing.
Okay.
Yes.
Oh.
So the project you're talking about is a property that you bought as a BRRRR.
Mm-hmm.
So you and your husband had the equity.
Yep.
And then what did the debt look like? Did they bring all the financing,
They
or
did.
did they bring the down payment for our money loan, or
They brought 100% of the financing for the purchase and rehab. And then
rehab.
Yeah, and then we were able to convert that to long-term debt once we were done with everything.
And you paid them just like points and
Yep.
interest?
Points and interest,
Okay.
yeah.
Kind of just standard hard money.
A little.
rates.
We got a slight family discount on that, but yeah, it was better than hard money.
Like
I
a
love
1 or
family.
2 and
Yeah.
8% or something?
It was I think it was
Okay.
like 10% and like a point or something like
Okay.
that. But I would rather pay a family member than a nameless
Yeah.
hard money lender. So that's kind of what our thought was on that. That way everyone's benefiting from that.
Sure.
And they trusted us because this was number 10 at this point. You
Okay.
know, like we've had a track record, which you guys have proven. Like you
Yeah.
guys have a proven track record at this point.
Yeah.
So I think that's really, really beneficial. So yeah, between the short term and the long term, and then the debt versus equity, I think that could probably take us down a lot of different discussions.
Sure. Yeah. So for your project, did you bring like the subs? Did you manage the project? So that's
Yes.
so again, you were providing value in that. I mean, not only did you have the expertise, but you were providing the rehab. A lot of times
Correct.
people want, I have friends who, I'd love to get into real estate, but I don't want to manage any of this, So from an equity perspective, like, yes, there's going to be a return. You're going to get some value from the money that we're making, and we're going to pass that on to you, but you guys are managing it.
Yeah, I think that's why I like debt partnerships better, because they, technically don't have a say in anything that you do from a control standpoint. So, all you got to do is pay them. You got to follow the note, and that's it.
Sure.
So,
but a lot of times people who might have a little bit more capital don't want to be involved. They understand that you're an expert in this. You have 10 other properties that you've done. They've turned out really well. They've been profitable. Great.
Yeah. Give me a quick
Send
return
me a
in
check.
a couple months, and we'll call it a day. Yeah, exactly.
How did you initially approach them?
They approached us.
Oh.
Yeah. They said,
better.
how can we work together? Well, how about we do this? I think if you just, tell everyone what you do, people are very interested in it.
Sure.
Yeah. And
Okay.
I think it's worthwhile to maybe get like a little portfolio, together to be able to show people that this is what I've accomplished. If anyone asks, like, what is it exactly that you do?
You do,
Yeah.
sure.
That was actually one of the things I jotted down to make a note of is like, have a portfolio. I mean, you got a marketing background, or create a website, whatever simple website. But
We have a website.
but are your properties up there?
Yes.
Cool. Because can someone go there and they can see, cool, these guys
Yeah.
have the experience.
Yeah,
they've
there's
got this. They've got these projects. Well, there's your portfolio.
Yeah.
Yes.
Great.
So there is a link to that, and I think maybe it's because I have a marketing background, but that's the easy part. Then it's like the nitty gritty of, well, did you get a lawyer involved? Did you write up a contract? I mean, because again, the devil's in the details, right? I mean, this could be, let's do this, and then all of a sudden, 2 months down the road, they're like, well, where's my money? And you're like, no, this is going to take 6 months. So just how did you structure?
So, admittedly, I don't know if I should be admitting this, but we have worked with hard money, and we might have tweaked their contract a little bit, copy paste on that. So yes, there was a contract in place. There was a note that was filed with the county. We did everything through
To the
title.
letter.
We did everything to the letter, because that's the last thing that I would want to happen, is to have a disagreement like that, especially when friends or family are involved. You know what I mean? So I think once all expectations are lined up front, and personally, they were going to get paid back no matter what. If I had to empty my piggy bank to get them paid, it was going to happen. So that would also be a consideration as well. Yeah.
Okay.
Yep. I'm very much by the book, though.
I think you
Contract
have to
wise,
be.
yeah, because it's just all expectations, and you never know what might pop up or what might happen.
Sure.
Mm-hmm.
Have you ever partnered with anyone?
I have. All sorts ones of business, a couple real estate deals.
Yep.
So my view on partnerships is, especially like long-term ones, it's basically marriage. I mean, it is a marriage. And going that level of seriousness. So I try to avoid partnerships as much as possible.
Okay.
Unless there's certain scenarios, because for example, like Jenny's bringing down like debt equity, great way to look at it. Like a lot of times they can be more
Yeah,
debt
that is a
instruments,
good-
which just keeps things simpler and cleaner and doesn't muddy the waters of things. But where I think partnerships can, like equity partnerships, whether you're talking business or real estate or whatever it is, and these are these long-term relationships, there has to be a 1 + 1 = 3 synergistic effect. Like if the three of us, we each can bring a different skill set to the table to do a project together. It can make, and it's like, hey, I can't do this without your help or something like that. Like my biggest thing is like, what's the synergy there? Does the greater part of it equal more than the individual? And a lot of times, hey, you can hire someone out to it, but you may not have the resources or knowledge or know, or like, hey, this person can do everything. Great. So I always look for, like, my biggest thing is like, is there synergy there? And if it's that 1 + 1 = 3, there's potential. Otherwise, I gravitate towards the way. I mean, I've had great business and real estate partnerships, and I've had bad ones on both. You know, good and bad on both. So I've learned about that, and also just everything has to be written, because I've had too many things where it's like, oh, I assume this, you assume this. Assumptions, you know, make an ass out of you and me, as we all know.
Yes.
So that's definitely, and you know, I'm definitely been very guilty of that. You know, it's so writing down, getting very clear, and really making sure that, hey, here is my role, here is your role with these scenarios. Who's it rolling down to? And in the case that we can't make a decision, if it's a third partnership, or you know, if it's a 50-50 or something like that, who's a tiebreaker? Or if it's, you know, a foursome, who's a tiebreaker? Like figuring out those things, and also death, disability, like stuff happens.
Sure.
Life happens, unfortunately, and making sure all that's figured out. So I'm very big on, like, it has to be synergistic, and then also it has to be written down, so then we're on the same page.
Yeah. No, I think that even from my husband and I, it's just us. We have a partnership agreement. We have an operating agreement. And I remember initially being like, we're married? Like, what? You need to make sure that it's in writing. God forbid something happened. Just, I agree with that wholeheartedly. Just making sure that the expectations are set properly. So has there been a good partnership that has worked really well? Because I love the equity, or excuse me, the debt partner, looking at it like that. I never thought to just find a debt partner that, you know, hey, somebody who has some extra money lying around.
Yeah, exactly.
My website is my email. You can email me if you have some extra money lying around.
Oh, that'll be on the show notes.
Yeah.
And you probably realize this. You may get some potential partners out of being on the podcast. So.
Oh yeah. I guess I didn't.
Registered?
No, I guess.
I was gonna say.
Oh, is this what we're doing?
FYI.
This is gonna be live.
Yes. Well, we're networking at scale
yes.
here.
Yes. Networking at scale. Oh, I like that.
So. I would, I think the debt equity, like if you're really looking for someone just on the finance side or just for the financing, I would try to definitely steer it more towards debt.
Yeah.
I just think that's the way to go, because with equity, there's just a lot of times there's often imbalances, and especially if someone wants to be completely silent. I get that, and then that can create, you know, different expectations down the road. So like, I think if you can stick to debt on financing as much as possible, unless there's like, hey, there's a certain situation where we need, like, hey, you're doing a bigger deal, we need someone to sign on the note for a certain type of loan or have this relationship. Well, then obviously that can, you know, be structured different ways.
Yep.
But there has to be a very big reason for them to have an equity piece.
Sure. Why they would be included in the
But
first
if they're looking
place.
for a return on the money, the debt side should fulfill it.
Yeah.
Yeah.
Mm-hmm.
Okay. Have you ever done strictly a rehab debt partner? I mean, I guess that would be the same thing.
Yeah, I haven't. I've used either hard money, this instance, or personal funds.
Okay.
Yeah. Lone wolfing it.
Oh yeah, and again, that's
as you guys are doing.
To this point, it's worked very well. We've leveraged, but not over leveraged. I think that's important to understand as well. Just making sure that, to your point, you were going to pay this family member back regardless, but making sure that that is a possibility.
Yeah,
and maybe even putting in the contract contingency plan, like what if it doesn't sell?
Yeah. Yep. We had a
or what if you can't get it rented?
Yeah, we had a foreclosure clause in it. They could have taken the house. You know what I mean? Like it was to the T.
Yeah.
Yeah.
Did you have a lawyer involved?
No.
But I mean, all of these things are. Yeah. And again, you're a smart person, and just making sure that, just from a contracting perspective, that's always, you know, making sure that everything's written. And
yeah, exactly. Yeah.
If I were to do that, I would definitely involve a lawyer, because I am not that detail oriented. So that's where it just comes down to personality.
I mean, I recommend getting a lawyer.
Yeah, well, yeah.
Sure. That's my official stance on it, but you know.
But so I won't play devil's advocate with you here. So, you know, because essentially a hard money lender, private lender, that is just a debt partner.
Totally.
Why not use hard money? Because I think a lot of times I've noticed, and I've done this myself over the years for just, you know, investments and businesses, is like, oh, I want a partner.
Yeah.
And you kind of I've gotten fixated on there.
Yeah.
And it's like, well, actually, I don't need a partner. I need a lender.
Need a lender.
Or I need to hire someone or whatever it is. But I mean, that's basically what our hard money lender is. And I've, when I've done one hard money loan for a flip. So I've got, the numbers, oh my gosh, I'm paying 2 points or 3 points, and like the numbers sound staggering.
Yep.
But when you actually sit down and run numbers, it's like you get triple digit returns because you have so few dollars in there. Oh, cool. Okay, I don't care. I'll pay you 10% because I'm going to make 300% of my money here. So why not just, if you're looking for capital, why not just hard money?
I think, honestly, I was probably where you were a few years ago.
Yeah.
I'm very debt averse, again, using my own money, which they always say use other people's money, right? And so I'm trying to change my mindset around that a little bit. So I think from a partner perspective, that sounds a lot, not better, but just it sounds a little less risky than a lender. But to your point, a lender, I mean, they've done this multiple times, and a partner, I think there's crawling in bed with a partner as opposed to a lender. I think there could be.
And it's easier to find the lender as a partner. Hey,
Totally.
lender, dude,
Yeah.
I mean, go out to any event and say, I need a hard money lender, and 3 will appear.
Yes.
So transactional.
Yeah. And then say, hey, fill out the
Transactional,
app, we'll look at
yes.
it. Hey, we can do this for you. And they already have all the liens, the lawyer,
Yeah.
the paperwork. So you have to figure it out.
That's what I like about hard money too, is that that's a second set of eyes. They're not going to lend to you if it's a bad deal.
Yep.
So that to me was very reassuring. I'm like, it was very, very scary entering our first hard money deal. Like,
It's expensive.
oh, it's expensive. I didn't really know what I was doing at the
Sure.
time, but I'm like, I think I'm
new.
right. I think this is right, So I submitted the proposal to them, and they're like, yep, looks good. So I'm like, okay, I guess I'm on the right track, because they wouldn't be giving me $100,000 if they thought it was a bad idea.
Yeah. Now, did your hard money lender look at your past?
So I was so
Did you have
green
to-
to investing that the first hard money loan we used was BRRRR number 2.
Okay.
So they really looked at my financials personally.
Okay.
So they took a deep dive at how much cash do you have, what's in your 401k.
Sure. Oh,
Yeah,
okay.
that
So
sort
like
of
your
thing.
net worth kind of deal?
Mhm.
Oh, okay.
Yeah.
And they want to make sure you're liquid enough that,
Sure.
hey,
That,
can you
hey, if-
can you pay
if we need
these
to-
or whatever?
Yeah. Yeah.
We need to collect.
Or can you survive past draw 1 if you don't hit, if you over budget?
Sure. Is that how it worked with the draw?
It depends. So
Depending on a
for
construction
mine,
loan?
it was just purchase, and then we funded the rehab
Okay.
ourselves. But it all depends on how
Depends.
it's structured.
Okay, and there's multiple ways to structure it. I
Oh,
have
there's
talked
There's
to-
about infinite ways,
my
because
gosh,
if
yeah.
It's
you've
all
bought your
negotiable.
primary, you've done conventional 30-year financing, that's very standard and bread and butter. Hard money, it's a blank canvas. They can
Okay.
get creative, they can custom ideas, they can do everything. So it's they've got a wide open canvas.
Another random question. Do you need to have a property in mind?
You
Or
can,
can
get
you
like
just-
pre-approved,
Okay.
like talk to them about it, and then say, this is what I'm looking
at.
for.
Okay.
This is my model. Then when you have that property, hey, do you guys approve this?
Okay.
So you want to get established relationship first,
Sure.
before you have the property, and then
Yep.
plus you can talk to a few, figure out the right fit for rates and terms, and also what Jenny said, like that, because they are a partner and they're not gonna lend on a bad
Lend.
deal. Their underwriting is usually really, really good.
Okay. Because I have talked to someone already to try to establish that, and they're like, "Oh, well, let us know when you're about to write that offer." I'm like, "Oh, well, we don't. Again, changing my mindset of, oh, well, before we just had the money and we could just make an offer and I know it's there, and it's just a little different when you're dealing with somebody who's needs to underwrite things, and
Yeah.
there's a process to this.
I know Chris knows my rule. Always find the lender first.
Yep.
And always find your 30-year fixed lender at the same time for your
Okay,
hard
for
money.
the refinance.
If you're doing a takeout.
Okay.
Yeah.
And have
we have a good
everyone
we have
in
a good
lockstep.
lender.
There's been a lot of horror stories where short-term lending doesn't match up with long-term, or long-term know that, and then the investor's stuck with, not a
So
good
what
place.
happens? So you have to find your
Well, because if you go ahead.
Yeah, I can tell you by mistake on my
Okay.
part. So the very first hard money loan that we took out, I didn't understand the concept of seasoning. So
Okay,
for
yep.
those of you who may not know what that is,
Yep.
seasoning is a requirement that the bank on the other end, so the long-term financing, will require that you hold and operate a property for X period of time. So it was like 2 days before closing of what I thought was going to be a cash out refinance, and the lender calls me and said, hey, we can only do a rate and term refinance. I said, what? I'm like, are you
because
kidding?
you hadn't held it long enough?
Yep, because we only had a 3
3 months.
3 month hard money loan. So I was like, well, what are we supposed to do? And they said, well, all we can do is rate and term your hard money loan. And then once you've seasoned it for 6 months, then you can do the cash out. So we had all of our rehab plus the equity that we gained stuck in the property for 6 months. So that was very disappointing and very good lesson learned for us.
Did you get a renter in there? What did you do?
Yeah,
A
we
renter.
just
So
we
you
just
just kind of
we
stuck
were
it
slowed
out
down.
and
Yeah, like we could have probably done, a couple more
another
projects
one.
at that point, but
Okay.
yeah, we had a good chunk of money stuck in that property.
Yes.
So yeah, got a renter.
That-
just waited it out.
is a great tip.
Yep.
Because again, I knew about seasoning, but I guess you don't think about that because you want to refinance out of that hard money as soon as you can.
Yeah. So we kind of developed a trick, which is I'll kind of go down a rabbit hole. Disclaimer: always check with your lender on this. But what we ended up talking to the lender that ended up bailing us out of that whole situation once we did the cash out refinance, he said, well, don't you know you can just do a rate and term refinance if you take out enough debt from the hard money, so get a higher hard money loan. Then if you have enough equity by the time everything's done, you can just do a rate and term refinance and there's no seasoning requirement.
That's creative.
That is
So that's
interesting.
how we were able to scale basically 6 at one time, because I didn't have any money in all of these projects and we were just buying them with hard money and getting a really high hard money loan, and then rate and term refinancing out of that hard money loan.
And the hard money looks at the ARV, right?
Yep.
So that's why you were able to get more, because obviously we're flipping this.
Yeah.
Or rehabbing.
Yeah. So to give an example, once we were once the light bulb clicked on that method, we saw 2 properties came up. They were estate sales. I knew that the ARV was going to be 165. I bought one for 114, one for 110, and I got 70 or 75% LT or ARV loan. So it was 120. So I actually got cash back at closing, and we fixed it up. It was, not a lot to fix up to get to that 165, and then we rate and term refinanced the 120 hard money loan into a 120 conventional.
Okay. And they let you do this multiple times?
Yeah.
Yeah. At the same time?
Yeah. It was a very stressful period, but I think that was a monumental, monumental impact to our whole portfolio.
Oh yeah, that's like a game changer there. All
Yeah.
that
Well, not to
stack
have
like that.
Yeah.
any of your own money. Again, I feel like this is
Yeah.
light bulbs are going off because all of our money is tied up in.
Yeah. So it was just really having that conversation with the 30-year fixed lender, and then going back to the hard money lender and being like, hey, he's saying if we do it this way, this works better for us. Can you guys do it this way? Yeah, we can do it this way. And at that point we had done a few with them. So that's kind of, just having that open dialogue with everybody that's involved is just key. Yeah.
Where were these houses?
Colorado Springs.
Oh, wow.
Yeah, I would.
Were they several years ago?
Oh, yes.
Okay.
I
I was
cannot
like,
replicate
114.
this. Yeah, I cannot.
Where you at, girl?
I cannot replicate this
Okay.
in this day. Yeah.
But still, that's,
Yeah.
again, a great way to scale.
Mm-hmm.
Use other people's money.
Yeah.
So I've got an idea to kind of maybe flip some of the stuff we're talking about here, because I know we talked a lot about, in today's market, is it easier to get money or easier to find a deal?
Easier to get money.
Money.
Yeah.
And you're putting a
You
lot
have
of
the
attention
deal.
on the finance, which you need. But I see an opportunity for you guys, especially with you guys to have experience, you have a track record, husband being a GC. You could also take the angle of hey, you want to do partnerships, and that is where, that can be definitely equity worthy, where, hey, there's a investor out there who's, newer and experienced, may or may not have capital, but they need, someone like, hey, I don't know GCs, I don't know how to run a project, I don't know how to do all this stuff. That's where experience and your guys' skills can come be very valuable, and in my mind, equity worthy, and not just debt worthy, equity worthy. And I would kind of put that out there and maybe consider that, because that can be a good way to do projects to leverage your skill set, but also be a way to help find deals as well. Because I think, deals are hard to find in lending right now.
Sure, yeah.
And that's a great strong suit that you have, because there's a lot of people out there who don't have the experience, don't know what to do, but hey, they find a property because they're out there hustling.
Sure.
And they're like, holy crap, I don't want to like run this whole thing by myself. I want to go with an experienced person. So there's potential there to actually kind of like flip all the stuff you're thinking about to help bring a different type of partnership opportunity for you guys.
Yeah, I think that the skill set that you and your husband have is far more valuable than money at this point in time.
Oh, well.
I do. I really do. So I think that.
Yeah, I guess I never thought about that. Like, oh, who has a deal for me?
Yeah.
Yeah.
Anybody? Bueller?
Yeah, and then just kind of thinking, you mentioned that you've left your W-2, which is, I understand how scary that is from just not being, financeable, having done that, a year ago. But I think there are other options for sure. Have you ever heard of a non-QM lender?
No.
Yeah, so they lend based on the deal.
Okay.
Opposed to the person.
Oh, okay.
Yeah, so maybe Google a few,
Okay.
after that, but that might be worthwhile because you have such a good track record, you have such a good portfolio, they will take that into account. Their terms generally are not as favorable as a conventional lender, but it's something.
Sure.
Yeah.
Is that like a portfolio loan? I've heard of
No.
those. No? Okay.
Mm-mm.
Different.
They have a lot of different products. So like they have rehab loans, they have flip loans, they have 30-year fixed loans. So again, just having that conversation. This is what I want.
Finding out the options.
Can you accommodate this?
Okay.
Yeah.
Okay. Yeah, I've never heard of that.
And it's also, same time, it definitely worthwhile to talk to like local banks for their portfolio loans as well, because they can look at your overall assets, or you guys are in business as well. Hey, you got your investing business, your realtor business, your husband's GC business. Like they can look at that stuff too, and they can give you potentially loans in there that you could not get without a W. You could not get it to a conventional lender.
Sure, a more creative way to lend. Yeah, because traditionally we've gone with the bigger companies, the Wells Fargo, these kind of companies. So we've not. There are options.
Oh yeah.
Yeah.
And if you do the hard money to take out conventional financing, go with the local lender. Do
Yes.
not do that with a big bank.
Yeah, no.
Okay.
We want to get out of what I just mentioned, that bank. But yeah, I've talked to a local lender about hard money, and they actually were more favorable than I thought. So again, it's just having the conversations.
Yeah, and just telling them this is
asking
what
the
I
questions.
want. This is what I can do. Does this work?
Yeah. What can you do for me?
Mm-hmm.
So I don't know anything about the legitimacy of this. Maybe Chris does. But I've heard in syndications that people will pay very lendable individuals a fee to take out a loan, I think in lieu of equity. Do you know anything about that, or how kosher that is for a 30-year fixed?
I know in syndications that's definitely a very common thing, especially if they're getting like the bigger properties, or if they're trying to do like a non-recourse loan, which is it's just tied to the property. It can't come through the owners of the property. And there's different ways to structure it to get the person that can sign on the note and can bring the net worth and the experience on there. The thing, it gets trickier with like the 30-year stuff, because I've talked to lenders about this. We have lots of clients, the truth. And one of the things, and I might be butchering it, but make sure you know. So let's just say, Catie and Jenny, you guys go on a property together, and it's a 30-year fixed property. And if you're both on the loan and you're both on title, you basically get half the income attributed to you, but the full debt contributed
for your debt to
you.
income. Okay,
so
it
can be poured to your debt to income because hey, great, you only have right title to half the income, Jenny. But if she doesn't pay, you're still on the line for 100% of the debt, and vice versa. So there's more nuances that way. And then I forget there's family and not family of, hey, just on title, but if you're on the loan, you have to be on title as well. And so there's different nuances on there, since that's more like a personal guarantee than like what the syndications are doing. So there's ways to do it, but it gets very nuanced. And really, really, really make sure you ask the lender like detailed, correct questions, because I've been through different lenders, gotten questions, and then you get the paperwork and it's different than what they said on the phone.
Sure.
And they're like, well, just ignore that in the paperwork. Okay, well that's no, that doesn't feel right to me.
Yeah.
So yeah, there are options to do it, but there can be some pros and cons. It can have some weird like DTI issues.
Okay. I don't know much about syndications at all. So from a partnership or from a lending perspective, I've never even looked into it. I mean, I've heard a lot of buzz about, syndications. So I wouldn't even know. I mean, I kind of understand what they are, but just from a...
Yeah, and that's for a much bigger, like, hey, you're taking down a commercial building, a retail space, or multifamily. You got to pull, it might be a $15 million purchase, so you're going to pull together $4 million in equity. And then there's, the basic structure that you got like the general partner who's running it, and then the investors will invest money, but they'll be limited partners.
Okay.
So they do have equity in there, but they have no say in operational stuff.
Okay.
So that's really much for the bigger stuff.
Sure.
You don't need to worry about for the smaller
Just
stuff, with just general like partnerships or hard money stuff.
Okay.
Yeah.
But good to know. I mean, if they're, because again, from a being in a hot market, having the option to, hey, there's a piece of land, like let's build a couple duplexes, and who's gonna help me do that, and that's something that is interesting to us as well, just from a building perspective. But yeah, that's a whole nother conversation.
What other questions do you got, or should we keep talking partnerships? I'm actually surprised we are only like 40 minutes into it and we haven't changed the subject on partnerships yet.
Yeah. I guess some partner horror stories. You said that you've been in, obviously no names, but just are there lessons learned from some of the bad partnerships that you've...
There's always lessons
learned. Lessons.
That's why I minimize them.
Yeah.
I make sure it's a synergistic relationship, and it's very clearly defined roles.
Yeah.
Those are things I've learned about, for me, how to structure them.
Yep.
And those have been very truthful. But when you get the right one, it's such like, I don't know, I like the aspect because it's fun to build. It's fun to have a teammate. It's fun to have like, hey, doing it together. Like it can be energizing, and it's really finding out, hey, when you get those right relationships, that's where like can be just a very, very powerful partnership.
Yep. Yeah, and the partnerships that have gone bad are the ones that you haven't had expectations aligned, and
sometimes it's just life. Like hey,
it's just not working
long
out.
business time ago, one of the guys went through a divorce, and his life just it took a very not a good left turn, and he didn't handle it well, and had a huge ripple effect, and learned about the whole buyout process then. So so
that's fun.
And so the other thing too is have you talked to any lawyers yet about the partnership stuff?
No.
Yeah.
No.
Talk to a lawyer sooner rather than later, because they can draw off the docs if you actually want to formalize it, which you should always do. I'll give you a few if you need some recommendations, and they're kind of like lending. Get that figured out before. But I think for your case, I would totally flip the script. I would focus on hard money lending or private money lending.
Yeah.
Do the debt partnership for your stuff.
Yep.
And possibly change your focus to where you guys, you've earned the spot to where you can say, hey, I earn a piece of that property or the upside because we have the experience and we can bring stuff to just get the damn project done of figuring out what to do, the rehab, this, that, blah, 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 whatever.
And don't be shy or turned off by high points and fees on a BRRRR. If you're going to hold it long term, you will not care in a few years from now.
Okay, yeah, because being a debt averse, again, that's sometimes scary. Hold on, how much is this? And to hold it. And we actually held a property a few years back. It was supposed to be just a quick flip, foundation issues. We ended up holding it for almost 2 years. And
on hard money?
No.
Okay.
It was our own money, but we had a HELOC, so we had a huge HELOC on our house that was paying, the interest was very high. We ended up having to, we short-term rented it to cover costs, and that ended up being we covered all costs plus made some, but just, you never know.
Yeah.
The market dips, or, it was seasonal. It went up on the market in like November.
Yeah. It's a really good point to bring up, though, is that there is interest rate risk in today's world. I have no idea what interest rates are going to be, 6 months from now.
Sure.
So the faster you can turn these things, the better.
Yeah,
for
the
sure.
timeline really matters.
Mm-hmm.
Whip my husband into shape. Hurry up. God, contractor. I'm just kidding.
So as we wrap up here, I would, for listeners out there, obviously you got a good feel for Catie's background, what they're looking for. Reach out. This is this is a big reason Jen and I do the podcast. It's amazing networking.
Mm-hmm.
Yeah.
So it's always a good way to reach out. So be open to that. People reach out. Debt stuff for private money lenders, hard money lenders. You'll probably get a few phone calls from them now. But also I'd be open to opportunities for finding like some new and experienced investor. If they find the deal, I would say you guys have definitely the track record to say, hey, we deserve a piece of equity in that property to get it done.
Yeah.
And make it a win-win. Teach them. You guys do profit, and creates a good relationship to more deals due down the road, or just whatever it is.
Yeah, I love how you guys always talk about bringing value, and
Yeah.
I think that's a good way to look at it. I never even looked at it like positioning ourselves as we have all of this.
Yeah.
You bring us a deal and let's.
You
have a
guys
lot
have
going
a
for
lot.
you guys.
You
Yeah.
have a lot. It's
And
very
it's hard to
impressive. Yeah.
appreciate yourself, or as
Yeah.
you do it, because it's just a grind as you do it.
Yeah.
But then
Yeah.
you grind, and 5 years later, it's like, crap, hey, I've done some stuff.
Yeah, yeah.
We've done some stuff.
And you've incurred the mistakes that you're going to prevent someone else from doing.
Sure.
You know what I mean?
Yeah.
So that's worth something in and of itself as well.
Yeah, the expertise and the lessons learned.
Mm-hmm.
Always a lesson learned.
So how can people get a hold of you? What's the best way? And we'll put the contact details in the show notes, all that stuff.
Yeah. So probably my email, happyhomescoltd@gmail.com. We're on Instagram as well.
And you're in Bigger Pockets, because that's where
I'm on Bigger Pockets.
That's where I can't remember how, but we originally connected a couple of years ago. I just remember we've messaged back and forth on there, back and forth.
I'm like, oh my gosh,
now we're
this
meeting in
episode.
person.
I know.
Yeah.
I was
So
totally
you're in Bigger Pockets too.
fangirling. I'm like, oh my gosh, Chris Lopez just liked my comment.
Oh my gosh.
No, but I've been listening to what you've been putting out for a long time. So
thank you.
Very valuable. It's awesome. Bigger Pockets, Catie Lawrence. All my information is there as well. So
Wait, Catie with a C or a K?
Catie with a C.
Yeah,
C-A-T-I-E.
I know how that goes. All right,
Everyone's like, Catie?
Yeah.
I'm like, oh my Lord. No, it's Catie with a C. It's like K-A-T-I-E, but C-A-T-I-E.
So step one, getting past the gatekeeper for potential partnerships, is spell the name right,
yes,
right?
spell the name right.
Attention to detail.
Attention to detail. Get it in writing. C-A-T-I-E.
Catie, this has been awesome.
Thank
you. And thanks for uploading that video for our casting call. It was awesome.
Oh, yeah. I was very excited.
Yeah, well, we enjoyed it. So this has been a cool episode. Listeners out there, you guys have questions. The show, I think it's a cool new series. Jenny had the thought of it a while ago. So, yeah, great job, Jenny.
Yeah, thanks. I hope that we can help a lot of people.
Yeah.
I think it is super helpful, again, to see real people, right? We are not I'm not a billionaire. I'm a real person, and you guys are real people, and it's providing the stage to be able to ask these questions. It's awesome. So I appreciate it.
Good.
Well, thank you. And listeners out there, obviously reach out to Catie if you guys want to connect, have interest, pick her brains, whatever. If you guys, need to talk to me and Jim or anything, reach out to us. You guys know the drill. We love networking. See you in the next episode.